Hi everyone. I hope everyone is fine. Welcome to our channel. If this is the first time you come to our channel, please watch our previous videos, then you will understand this topic well. I will leave those videos and playlist links in cards. Okay, without wasting our time, let's get into the topic. Here is the topic. Okay, for simplification purpose, I am dividing this video into 7 topics. Let's see the topics. These are the topics. The first one is intro of Forex. Later, we will discuss the pips. And the third one is lot sizes. The fourth one is spread. And the fifth one is leverage. The final 2 chapters are most important. One is technical analysis, and the final one is fundamental analysis. So, these are the 7 chapters we are going to discuss in this video. So, without any wasting time, let's get into the main topic. Let's move to the first chapter, Forex basics. The word forex is a mashup of foreign exchange and is commonly used to refer to the foreign exchange market, the largest financial market in the world. Picture a massive marketplace trading across all the corners of the globe, but rather than having goods on sale, this market trades in global currencies. The forex market or foreign exchange market is one of the most widely traded markets in the world, with daily trading volume of over $8 trillion. If you guys live in the United States or like me in India and you've ever traveled to other countries for vacation, that's going to be your first introduction to foreign exchange. For example, when you travel to India right now, if you give them $1, they will give you 88 rupees. That is the current exchange rate. So if you exchange $100, you will get 8,800 rupees. You can have a lot of fun in India with a dollar. Now we can get into the deeper stuff. Let's look at Euro US dollar. This is the most commonly traded currency pair. And right now, for €1, you would need $1.04. Now you might be asking yourself, what does that mean? And how do I make money off of it? When you are trading currency pairs, we will discuss that later. Because when you trade Forex, you are buying one currency while selling another at the same time. Let's look at the pound dollar currency pair, for example. The first currency in a pair is the base currency, and the second currency is the quote currency. Let's say you get a quote of pound dollar as 1.26. This means for every 1 pound you get 1.26 of US dollars. There is always an invisible one beside the base currency on the left. So here's what happens when you actually trade currency pairs. When you buy a currency pair like the pound dollar, or when you go long on the pound dollar, you're expecting the pound to appreciate while the dollar depreciates. When you sell a currency pair like the pound dollar, or when you go short on the pound dollar, you're expecting the pound to depreciate while the dollar appreciates. Major currency pairs. These are the major currency pairs, which all include the US dollar. I think you understand the term Forex and the code of Forex pairs. So, let's move to the next chapter, pips. What is a PIP? In the land of Forex, exchange rate changes are measured in pips. A PP stands for a percentage in point or a price in trust point. This is a standardized measurement for the smallest whole unit price move that an exchange rate can make. If the euro dollar is sitting at 1.04420 and its value gained by 1 pip, it would move 0.04430. Most currencies are written to the 4th decimal place, with the 4th decimal place representing 1 pip. However, some exceptions buck this trend, such as with the yen-crossed pairs. The Japanese yen often quoted to 2 decimal places. So 1 pip gain would be 151.991 rising to 152.001. There's also a pipette, which is a fractional pip that is 1/10 of a pip and is represented by the 5th decimal place. Before we continue, we want to hear from you. If you have any doubts, tell us in the comments below right now. Okay, I think you understand the pips topic. How to calculate the pips. Okay, let's move to the next chapter, lot size. In Forex, positions are usually measured in lot sizes. A standard lot represents 1 lakh units of the base currency. A mini lot is a tenth the size of a standard lot and represents 10,000 units of the base currency. A micro lot is 1,000 units of the base currency, and a nano lot is 100 units of the base currency. A standard lot is a unit of measure of the amount that you're purchasing. So for example, if Euro USD is 1.04 and you want to trade one standard lot, which is 1 lakh units in order to place that trade, You need $1,13,000. So, this is how the lot size works. If you don't have more capital, at the same time, if you have the trading skills, there is no one to stop you. 0K. This is a brief note on the lot size. Let's see the next chapter. Spreads. Each transaction has a bid and an ask price. These two prices form the basis for trading on the Forex market. When you're looking to buy an asset on the Forex market, you will pay the ask price for the base currency. When you're looking to sell an asset on the Forex market, you will sell at the bid price. The difference between the bid and ask price is called the spread. Spreads are enemy to us because due to spreads your stop loss may hit. That's why you have to choose a best broker. The bid-ask spread is the difference between the price a dealer will buy a currency and what they will sell it for. The spread covers the dealer's profit and the cost of the transaction. It is essentially the cost you pay to enter the market. It's important to note that different brokers can offer different spreads, or they may offer variable spreads that can change based on market conditions. Spreads are enemy to us. So select a best broker. Who gives the tight spreads? Okay, let's see the next chapter. Leverage. Brokers and leverage. You, as an individual retail trader, require a broker to access and trade the Forex market. Brokers provide leverage, which is you using borrowed capital from the broker to trade larger positions than you otherwise could with the amount of money in your account. Imagine leverage like using a financial lever. With a lever and minimum strength, you can lift heavy loads with less effort. Like a lever that magnifies physical strength, financial leverage magnifies your trading power. Essentially, leverage turns up the volume on trades. However, with the potential for more profit, leverage may attract you. But the high leverage is very dangerous. If you take high leverage, it means you're sitting on a snake's case. At any time, it will kiss you. It's important to keep in mind that leverage can act as a double-edged sword. Leverage offerings vary from broker to broker and are usually expressed in a ratio such as 1 to 50, 1 to 100, or 1 to 500. Usually, traders will be required to deposit a margin of the trade to act as collateral for the leverage position. So this is the basic to advanced level of discussion on leverage. I hope all your doubts are clear. Even though if you have any doubts, let me know in the comment section. So, let's go to the next chapter, technical analysis. With technical analysis, traders study historical price movements and data in order to identify similar patterns that have the possibility of repeating themselves in the future. The idea here is that the market is not going to be able to do that. History loves to repeat itself. Think of technical analysis like a detective hunting down clues to uncover how an individual acted in the past in order to try and predict how they will act again in a similar way in the future. Here are a few simple examples of technical analysis in action. Let's see the chart. See, this chart looks like an uptrend. How can I tell without using any indicators or using any structure breakdown? Here the point is to know the positions of the highs and lows, and moreover the candlestick types. See, here the price forming higher highs and higher lows. What it means, price in uptrend. What should we do when price in uptrend? We will take only the buy trades. So in trend, that means now we're expecting this price will move upward, but we don't know the exact range, exact time of the next pump. That's why here the strategies came. If you have an excellent strategy, it will signal you the exact timing to capture the move at right time. That's I came with the Hope Pip strategy. Don't confuse with this name. It is nothing but support and resistance strategy. Just you have to do is practice it in the simulation sessions. Master the setups I am teaching you. Those are very important. If you don't know how to watch them, I will give the links in the cards. You can watch them from here. Let's see what will happen next in this chart. See, as we predict price moved upward. That's why I'm telling you all the time. Please focus on the price action. Don't depend on the lagging indicators. Okay, let's go the last chapter. Fundamental analysis. Fundamental analysis determines the intrinsic value of an investment to determine its value rather than historical price action or market sentiment. Forex traders look at the economic conditions that affect the valuation of a nation's currency. There are many economic indicators and private reports that can be used to evaluate Forex fundamentals. It involves analyzing a country's economic indicators, central bank decisions, political events, and other fundamental factors to predict the future direction of a currency's price. If you think about it, this makes a whole lot of sense. Just like in your Economics 101 class, it is supply and demand that determines price, or in our case, the currency exchange rate. Using supply and demand as an indicator of where price could be headed is easy. The hard part is analyzing all of the factors that affect supply and demand. For example, let's say that the US dollar has been gaining strength because the US economy is improving. As the economy gets better, raising interest rates may be needed to control growth and inflation. Higher interest rates make dollar denominated financial assets more attractive. In order to get their hands on these lovely assets, traders and investors have to buy some US dollars first. This increases demand for the currency. As a result, the value of the US dollar will likely increase against other currencies with lesser demand. Since currencies are always paired, their performance is determined relative to that of another currency. Like this, the fundamental analysis works. So you have to do is connecting the points and imagine the whole structure and enter the room of 1% club. Okay, this is the fundamental analysis basics. Actually, it needs a dedicated video. In future, I will make a separate playlist on the fundamental analysis. Today, we will discuss on what is the reality of Forex trading, what I observed in my 4 years trading experience. Beginners confused to follow the strategies in market. Guys, I'm telling you this with my experience. If you don't stick with one strategy, you are not gonna see any profits in your career. So stick with one chart. Practice past data up to 4 years in soft 4FX. Nowadays, new traders attracted to these internal curve trader, small money concept. These two are excellent for their mentors, but not for followers. I think you got my point. They literally attract their students with trading cue drawings with 1 to 10 and above, but they don't tell about the losses before the win. So many trades lose their accounts by overtrading. You can't control your mind. Finally, you blame the market. Who manned this market manipulated by big players? Yes, it does by them. But we can identify the move with some particular rules based strategy. Here the thing is many traders don't know the rules, specific timings, when will volume came into market. A professional trader take 2 to 3 high quality trades in a week with 1% risk. He gained 4 to 6% a week, means 112 to 288% a year. But that was rare. Average they make 24 to 50% a year. It's enough to build a millions dollars account. Here our strategy is simple. No indicators, no long watch time, no overtrading, no complicated structures and terminology. Simple setups. With this, you can easily make above 2% profit in a month. 2% per month is a lot. You can easily beat banks, your job salary, any investment in stock market. Okay guys, here I am introducing our strategy support and resistance. Very simple strategy. No need to watch chart whole day. Just 2 hours to 4 hours daily enough. It is also useful to job holders. You can manage your work while trading with this strategy. What is support and resistance? Resistance is nothing but the zone where the price previously rejected. Technically, we draw it above the bearish candle that formed after bullish candle. Support is nothing but the zone where the price moved upwards. Technically, we draw it below the bullish candle that formed after bearish candle. Isn't it looks like simple? Yes, it is very simple. But the timing and range matters here. There must be above 25 pips range between our support and resistance and target. Otherwise, it is invalid. Here some examples. Here I came with a few examples. Example number 1. This is a chart of GPB JPI. It looks very confusing, right? After drawing support and resistance, it will look logical. We can easily predict price move. Rule number 1. Range must be above 25 pips between sandar and target. This is the zone where bearish candle formed after bullish candle. From here the range is 16 pips. Just 16 pips range. So this is not valid resistance. Move to next zone. Awesome. Look at that range, 51 pips range. Perfect resistance. And this will be our buyer's target. Let's move to identify the support. Support is at below bullish candle which formed after bearish candle. Here this candle satisfy our rule. Let's calculate the range. Woo, look at that range, 49 pips. So it is a valid support. And this will be our sell side target. Let's see what happened next. Look at that. Price broke resistance and closed above. This is our confirmation candle. This is rule number 2. Wait until the confirmation candle is formed. Entry will be here. Target is here, nearly 1 to 2 ratio. Stop loss is based on yours. You can put at current candle low or you can put it below previous candle. Let's move to second example. This is the zone where bearish candle formed after bullish candle. From here the range is 7 pips. So it is invalid resistance. Move to next zone. Look at that range, 72 pips range. Awesome. Perfect resistance. And this will be our buyer's target. Let's move to identify the support. Here our support zone. Here range is just 6 pips. So invalid support. Let's move to next support zone. Here the range is 45 pips range. Here this candle satisfies our rule. Rule number 1 satisfied. And this will be our sell side target. Let's see what happened next. Look at that. Price broke resistance and closed above it. This is our confirmation candle. Rule number 2 satisfied. Wait until the confirmation candle is formed. Entry will be here. Stop loss is based on yours. You can put at current candle low or you can put it below the previous candle. Let's move to the third example. This is the zone where bearish candle formed after bullish candle. From here the range is 116 pips. Awesome. Rule number 1 satisfied. Perfect resistance. And this will be our buyer's target. Let's move to identify the support. Support is at below bullish candle which formed after bearish candle. Here this candle satisfy our rule. Let's calculate the range. Range is just 21 pips. So not valid support. Let's move to next zone. Look at that range, nearly 29 pips. So it is a valid support. And this will be our sell side target. You can also put your support here for better trade. Because this range was 50 pips range. Let's see what happened next. Look at that. Price broke resistance and closed above it. This is our confirmation candle. Rule number 2 satisfied. Entry will be here. Stop loss is based on yours. You can put at current candle low or you can put it below the previous candle. These are the examples. I think you understand well. So this is how professional traders draw resistance and support. Moving to next section, our strategy results. Now I will show you our strategy results. Here this sheet shows us the monthly profits. The edge of this strategy is losing small, gaining big. And this is the graph shows us how our account growing month by month. It looks like price in line chart always moving upwards. Moving to next slide. This is our October 2024 results day-wise. Our aim is lose less, gain more. If you like this video, I want just one thing from you. Subscribe to our channel for more content like this. Click on bell icon, then you will not miss my video. Share this video. Thank you. Okay guys, this is the end of today's topic. So what is a Forex market session? We'll also cover what are major Forex market sessions. We'll cover the open and close times of Forex sessions, then trading session overlaps. Because in Forex trading, the best time you can trade Forex is when different market or different sessions overlap. Let's just say you have. We'll go into different session or different market Forex sessions very soon. But the best times you can trade is when most of these sessions overlap. So we'll go detail into that in this video. Let's go to what we call what is a Forex session. Forex market hours run 24 hours a day during the week, but the market is closed on weekends. Normally the Forex market is open like 5 days, 24 hours a day and 5 days a week. So on this, when we're talking about Forex market sessions, we'll be using the GMT and the Eastern Time. GMT is mostly the Greenwich Meridian Time and also the Eastern Time. You can convert the time zone to your present time zone. We'll be using the GMT and the Eastern Time. We have something which is called the Sydney session. The Sydney or the Australian session, and once the Sydney or the Sri Lanka session opens on Sunday at 10 pm, that is when the trading starts. That is when trading starts and the market is closed on Friday. The New York session closes for the weekend. 5 days a week, the market is open on Sunday at 10 pm Greenwich Mean Time, no matter where you're located. Let me just take India for an example. In India, my time is GMT plus 5:30. So the market opens at 3:30 a.m. or after midnight on Monday and it closes on Saturday. On Saturday, it closes at 3:30 a.m. when the New York session is closed. So that is what they call Forex market session because the opening and the closing time is determined by different Forex market session. The Australian or the Sydney session and the closing time is determined by the American or the New York session. We'll be talking more about the different Forex market sessions when we go further. So now let's talk about what are the major Forex market sessions. I've already explained to you what is a Forex market sessions, in which they could easily track movement and measure different transactions in Forex trading. They came up with something which they call Forex market sessions. In Forex trading, there are three major Forex market sessions. The first one is the Tokyo or the Asian. The second one is the London or the European session, and the third one is the New York or the North American session. The different Forex market sessions, they're able to use the financial hubs, the cities or the capital, the financial hubs of those particular sessions. Like in Northern America, they used New York as a financial hub. New York was determined as a financial hub. That is why it is called the New York session. In Europe, London was considered as a financial hub. That is why it is called the London session. In Asia, Tokyo. That is why it is considered as the Tokyo session. So for the Asian people, for Asian countries like Switzerland or like Tokyo, China, India, Taiwan, and all of that. So for the Asian people, for Asian countries like Switzerland or like Tokyo, China, India, Taiwan, and all of that. So for Asian countries, you have the Asian session or the Tokyo session. So we can either call it the Asian session or the Tokyo session. This session starts at 12 am and closes at 9 am as per GMT. Mostly I avoided Asian session because if I want to trade this session, I have to get up at 5 am mist. That was too early to start a day. That's why I don't trade Asian session. We have the London session or the European session. We can either call it the London session or you call it the European session. London, this is one of the favorite market session. When we go along on the video, we are going to explain why the London session is one of the best sessions which you can trade and how you can trade the London session. So the London session in UK, the time it opens at 7 am and closes at 4 pm as per GMT. In IST it opens at 12:30 and closed at 9:30 pm. So you can see this is one of the best sessions that I can treat because this is the one that fit on my time zone. We have the New York session. So here we have the New York session or the North America because the whole of this session represents New York. New York session opens at 12 pm and closes at 9 pm as per GMT. So those are the three different major market sessions which we have in Forex. The three major market sessions which we have in Forex, which are the Asian, the New York or the North American session, the London or the European session. If 12 a.m. in GMT, it means 5:30 a.m. in India. That is how you calculate the different market sessions to be able to know the time. If you are in New York, which is I think in North America or New York, they use what is called the Eastern Time. So there it means the forest market opens at 4 p.m. and closes at 1 a.m. So no matter where you are, you can easily use that to determine the forest market session. The Tokyo market opens at 9 a.m. and closes at 6 p.m. The same thing on GMT, the same thing on Eastern Time. So with that being said, we also have the New York session. The New York session opens at 5:30 p.m. and closes at 2:30 a.m. next day in IST. Or in GMT, it opens at 12 p.m. and closes at 4 p.m. Trading sessions overlap. This is something which is the reasons why we even talk about Forex market session is because of the Forex market overlap. Because when two Forex sessions overlap, there's high volume at a particular point in time. So anytime you want to trade Forex, if you see that, okay, there are two market overlaps. If you see that there are two sessions which are overlapping, then that is the best time to trade the currency pairs which are made up of those sessions. You can see here we have the trading sessions overlap. Here Sydney session opens at 8 p.m. and closes at 5 a.m. as per GMT, or in IST opens at 1:30 a.m. and closes at 10:30 a.m. Moving to Tokyo session, it opens at 12 a.m. and closes at 9 a.m. in GMT, or opens at 5:30 a.m. and closes at 2:30 p.m. Here you can see the Sydney and Tokyo overlap timings from 5:30 a.m. to 10:30 a.m. This is the best time to trade in Asian session. Moving to next overlap timings. Here London session opens at 7 a.m. and closes at 4 p.m. as per GMT. And New York session opens at 12 p.m. and closes at 9 p.m. as per GMT. Here you can see the overlap timings of London and New York. From 12 p.m. to 4 p.m. This is the best overlap timings. These are very high volume times. Here I leave this zone. This is overlap of Tokyo and London. Just 30 minutes overlap. That's why I don't tell this. So finally from 5:30 a.m. to 10:30 a.m. and from 12 p.m. to 4 p.m. These two are the best overlap timings. This is very very important because at this particular point in time, based on your time zone, if you see that there are two forex market overlapped at a particular point in time or at a particular point in the day, then you have to be able to choose currency pairs that fall between those two sessions. I think you understand it. Let's move to next chapter. Best pairs are chosen according to session you trading. In the market, there are several pairs are available. These are divided into major pairs and minor pairs. Major currency pairs are any pair that include the US dollar, which currently holds the position of the largest economy in the world. Major pairs are the most widely traded currencies in the foreign exchange market. Here are the 7 major forex pairs that are considered to be the most popular across the world. Minor currency pairs, also known as cross-currency pairs, do not involve the US dollar. They pair two other major currencies or a major currency with a currency from a smaller or emerging economy. Here is a list of minor currency pairs. Every beginner confused to choose best pairs in these pairs. For me at beginning, I trade all these pairs all the day. I wasted my 2 years' time. So I want that don't waste your time by trading all these pairs. So which pairs are best to trade? Let's move to reveal that. We separated these pairs according to sessions. Remember one thing. In the pair, one currency must active and one must be inactive. That pair is the best pair. If two currencies are active, the pair is mostly consolidating. See here on screen. For Asian session, these pairs are best. In these pairs, one currency is active and other is inactive. Same for London session also. Here, these are the best pairs you can trade in London session. Look at these. These are the best pairs that can trade in New York session. I hope you got my point. Don't trade other than these pairs. Let's move to next chapter. For example, here the Sydney and the Tokyo market is overlapping. So the currency pair which is best to trade at this point in time is Sydney is Australia. So it will be the Australian dollar. So it will be the Australian dollar and the Tokyo. The Tokyo is what? The Japanese yen. At this point in time, the best currency pair that you can trade, which is going to be very, very liquid. The best currency pair that you can trade would be the Great Britain pound and the Japanese yen in this overlap timings. Because GBP is inactive in this period and yen very volatile, so this combination gives us best volume. Because no matter if you check all the other currency pairs, there are some times where the Forex market is totally quiet. Even though they say the Forex market is open 24 hours a day or 27 hours a day, there are some times of the day that the Forex market is quiet. And it's not advisable to be trading at these particular times because if you try trading at these particular times, then you might even end up blowing your account. So you need to know where to say, okay, this is not the best time to trade. Let's look for another overlapping in the market and then determine the currency pairs which we can trade at that point in time. Let's just use the London session and the New York session. This overlap starts from 12 p.m. to 4 p.m. as per GMT. I explained here for you to be able to pick the currency pair to trade. Which currency pair can you easily trade here? The London we have, the currency pairs you can trade for the year is GBP and USD because you have the London section and New York. At this particular point in time, the GBP USD is going to be very volatile. If you check on your chart, it's going to have volume and you can only trade if there is a volume. So this is the best time you can trade GBP, JPI or gold because here yen is inactive and pound very volatile. So you see those are the currency pairs that you can trade at a particular point in time because the forex market is very liquid at that point and there is also volume at that particular point in time. I personally trade these two pairs only. Particularly in these two pairs, 90% of my trades are taken in gold. Let's move to next chapter. Two trades daily. What is that meaning? It is nothing but we set a limit to our number of trades daily. It is the only medicine to our greed. Otherwise, you may lose your account by overtrading. Just two sessions a day, two pairs and two trades. For easy purpose, we call it as 2 cube strategy. This is the secret of my success 2 cube. So let's move to examples. If you like this video, I want just one thing from you. Subscribe to our channel for more content like this. Click on bell icon, then you will not miss my video. Share this video. This is example 1. GJ chart. It is Asian and Sydney session overlap time. The reason why I choose GBP JPY is one currency is active in this pair. According to time zone, British pound is inactive. At this time, this currency moving based on yen. In the previous video, I explained how to draw support and resistance. Here is our resistance level, and here is our support level. At present, there is no confirmation candle. See, this candle breaks the support. So I took sell entry here. Let's see what will happen. Stop loss at previous candle high. Target is here. This is how we choose pairs according to session and volume. Moving to next example. In this example, we choose GBCHF. Here time is 11 a.m. in AST. So it is pre-London session. In London session, these both currencies are active. Here the support level. Look at that price action. So many wick rejection. Because of these currency combination, its price action looks like this. This is very hard to trade in this pair. Okay, let's draw resistance here. If candle closed above, I will take buy. Adjust this resistance to here because this is valid. Okay, let's take buy. Stop loss current candle low. See our stop loss triggered. That's why I don't trade like these pairs. Let's move to next example. This is gold. Look at that time. It is 5:30 p.m. in IST. So it is London and New York sessions overlap time. At this time dollar is very active. Let's draw resistance here and support here. See candle closed above it. So it take buy here. Stop loss at resistance. Look target hidden. That's why I choose gold here. Very volatile pair at this timings. And these topics on screen. If you are a beginner to trading Forex, whether you are one day in one weekend, one month in whatever you're in, I think that it's important to talk about the proper markets to consider when trading. As a beginner, and honestly just trader trading in general, you want to find the best markets that are suitable to yourself. I am telling you now, you are in right path. Let's get into topic without wasting our time. First topic, different types of pairs. Best pairs are chosen according to session you trading. In the market, there are several pairs are available. These are divided into major pairs and minor pairs. Major currency pairs are any pair that include the US dollar, which currently holds the position of the largest economy in the world. Major pairs are the most widely traded currencies in the foreign exchange market. Here are the 7 major forex pairs that are considered to be the most popular across the world. Minor currency pairs, also known as cross-currency pairs, do not involve the US dollar. They pair two other major currencies or a major currency with a currency from a smaller or emerging economy. Here is a list of minor currency pairs. So many traders trade forex market without knowing details of forex pairs. Each pair has its own foundation. It moves based on the foundation. Here foundation means who dragging that pair. For example, a currency runs based on current government policies, their experience in running government, the bank which regulates the country economy, and so on. So many factors decide the movement of a currency. So this is the concept of forex pairs. Let's move to next chapter. Pairs that perfect to your trading. Various markets is that have different behavior. Gold trades differently than the stock market. Stock market trades differently than the Australian dollar. The Australian dollar trades differently than the US dollar. Each one of these markets is like, think of it as like one big family. There's lots of different characters, parameters, and personalities within the family. You might have sort of the more crazy, unpredictable friend, or you might have your colleagues or whatever, right? Each one of them has their own character. And it's going to be important as a new trader, and just as any trader, to pick markets that are suitable to the strategies that you are trading. So here the main factor is based on you. Whether you're familiar with stocks or with currency fundamentals, whatever you trade, you must know the best template that suits your trading style. That's going to be the first point that I have for you before you choose a market to trade. You really do need to make sure that you have a proper trading plan and trading strategy. And most important is you have to have rules-based strategy that stops you over trading, that stops you blowing your account, that protect you from your own emotions. I think you got my point. Before you go jumping into various markets and just putting your hard-earned money on the line. With that said, once you have your trading plan, assuming that you've done some backtesting, you've spent some time, it'll become more clear to you. Over time, which markets are more suitable to you through backtesting and things like that. But today I'm going to give you my picks or pairs that I think are the best or better places for newer traders to explore potential trading opportunities and strategies. With that said, the first thing I want to show you guys is this. I mentioned some markets earlier. I talked about things like gold stock market. There's also the US stock market or Indian stock market. For example, US 30 is an index that a lot of traders like to trade on forex brokers. So you have things like gold US 30. You have things like oil. You have things like GBP, JPI. And in Indian market, there are Nifty 50, Nifty 100, etc. And there's something that is a similar trait in all of these different markets. And the main thing is all of these have high volatility, as I covered in my last video. So high volatility is a common factor in all of these markets. Why is that matter? Well, a lot of new traders, they gravitate to these sort of markets. They all want to trade gold and US 30 and oil and Nifty 50 because they sound cool. They're exciting markets to trade. But I will say, I think that this is a very, very dangerous path for new traders because high volatility. What this means is that if you're trading with high volatility, you can make a lot of money in a short period of time trading US 30, gold, and Nifty 50. And that's what attracts new traders. Ultimately, they blow their accounts. They empty their savings. They choose the scary part though, and the part that honestly is where people lose all their money is that with that high volatility, you can very quickly drain a small trading account and lose a lot of money trading these sort of things. They are great when they are going your direction. They are very awful when they are going against you. So I am actually going to say that as a new trader, I would say it's completely better to avoid trading all types of markets. But these high volatility markets, until you know what you're doing, until you feel a little bit more confident in trading execution and how your broker works and MT4. And once you sort of feel more comfortable across the board, I would stay away from these things personally, just because high volatility is really, really bad. Because what happens is with new traders, they often make mistakes. It's very normal for anybody who's getting into this stuff to make mistakes. But learning from mistakes is important. You might accidentally overleverage, or you might accidentally take too many trades or overtrade or get frustrated and make mistakes. And you don't want to be making those mistakes on something highly volatile like crypto. You'll blow accounts and you'll lose a lot of money very, very quickly. So we don't want to be doing that. Instead, in my opinion, I think that it is better to stick to some of the lower volatility markets. At the same time, they must have high volume. So let me list off some of those currency pairs for you. So let's move to next chapter, secret pairs. Some of the markets that I think are a little bit more suitable and a little bit more forgiving for new traders. Assuming you don't over leverage and do stupid things, which by the way, you can lose a bunch of money on any market. But I think that these ones are a little bit more suitable towards beginners. Things like gold, things like GPJPI. Why did I put these? These are less volatile and have more volume, smooth movement and no large pips candles, so that your stop loss can be small. Other side one more to consider would be things like year, CHF. Okay, so a couple things about these pairs. These pairs are inherently higher volatility, okay? They're not going to get wiped out by a gold move that they didn't see coming, and they had no idea why it's happening, and they took a too big position. So here choosing best pairs is not enough. You have manage your risk. Later we will discuss the risk management. So it's probably best in my view to stick to the lower volatility markets. Now, there's also some advantages to things like EURUSD and USDCF specifically. These two are very liquidity. And what I mean by liquidity, if you are not familiar with what I mean, we will discuss this topic also in future videos. First, we're gonna discuss about gold. Central banks maintain reserves of paper currency and gold. The price of gold generally rises as central banks diversify their monetary reserves away from paper currency and towards gold. Several major countries have reserves that are largely made up of gold. Global central banks have acquired the most gold since the United States abandoned the gold standard in 1971. According to Bloomberg's fundamental analysis of gold, with 2019 figures lower than 50-year high set in 2018. According to the WGC Council, in 2019 Turkey was the greatest importer of gold. The next were Russia, Poland, and China. Overall, governments purchased 650 tons of gold in 2019, a slight decrease from the 656 tons purchased in 2018. This is still approaching the highs not seen in 50 years. As per some business analysts, the rate of interest and gold has a negative relationship under normal conditions. A rising yield suggests that the economy is expected to be robust. Inflation is caused by a robust economy. Gold is seen as an inflationary hedge. That makes it one of the factors affecting gold prices. Furthermore, due to the rise in interest rates, traders flock to fixed income investments. Therefore, demand falls while prices stay unchanged. So may factors like this moving the gold and make it one of the best pair. Let's discuss about GBP/JPY. The British pound is the world's fourth most traded currency, whilst the Japanese yen is the world's third most traded currency, resulting in a very liquid and popular currency pair. This, coupled with its consistently high range and volatility, makes it a great candidate for both medium-term and long-term trading, although it is also very popular with scalpers. The GBP/JPY is one of the most widely traded forex pairs. A lot of traders actually prefer it to the major pairs because of the potential it provides. Additionally, trading the GBP/JPY gives you exposure to some of the most important economies in the world. So gold and GBP/JPY, these two pairs are so heavily traded. These are the two major currencies. They are like some of the two biggest, or I think they are the biggest pairs. So you've got the two biggest currencies trading back and forth. So there's a ton of trading volume. And with that high amounts of trading volume, what that means is that you get low spreads on your broker. When you enter a trade, for example, let's say that you're looking at a chart and you want to buy the gold. So we're looking at XAUUSD and we decide we want to buy this pair. Whenever you enter into a position, if you were to buy this pair, your broker is going to give it to you slightly higher than where you wanted to buy. That is the spread. That's how the broker makes money. Now these spreads, so that distance can be bigger or it can be smaller depending on the pair that you're trading. The volatility in the market, at what time you are trading, the liquidity in the market at the time, how many orders are going through, and so on. And the time of day has a big deal on that as well, as we discussed in last video. By trading the two, you'll pay very little to your broker compared to other markets out there. So these are things to all consider. So by that standard, you're going to be getting into these pairs much easier, much quicker with less spread. So that can be a huge advantage just to sticking to things like gold and very liquid market. And then you have in euro dollar. That's another thing here. We're gonna discuss in next chapter. So let's move to next chapter, reason why I choose these pairs. If you watch this video up to this, I think you might like my videos. Please subscribe to this channel for more content like this. Share this video to your trading friends. Click on bell icon for faster notification when I uploaded videos in this channel. If you're trading, gold and you take a buy trade and then the market goes against you, it might be 10 pips in the span of 2 to 3 minutes. Whereas if you're trading something like Euro USD, let's assume that this was Euro USD in that same period of time, you might get 30 pips, which can be very, very dangerous. That's why I'm sticking to these highly liquid pairs that are a little bit lower volatility, things gold and GBP/JPY, and go get your feet wet with these things. These pairs are very suitable to our strategy. I am telling this by back testing them. Let's see what I am back testing. See here, I put them in my laptop. I back tested up to 2019. See, I have those PDFs and those back testing files. These all will available soon. So finally, for beginners, what I am saying is, use a demo account. Don't go put your hard-earned money in the market until you feel comfortable, but try out our concepts on these pairs. And moreover, for our subscribers, I have lot of tools to give you guys for free of cost. They are available to you going through this course. If you want to access them now, then join in our Telegram group. Finally, what I am saying is things are a little bit more calm. That can actually be a huge advantage, especially in this trading game where psychology and getting frustrated and dealing with the mistakes you make as a new trader. Today our topic is trading plan. For every trader, first main thing is having a proper plan. Second one is execute it. and the final one is doing it consistently. These three are the main important pillars to a trading plan. I am giving you my surety that plan is the best. For making it simple, I am dividing this topic into the first one is best pairs. The second one is a perfect broker. The third one is setting rules. And the final one is journaling. We will discuss all these one by one. Okay, let's move to the first chapter. Okay, here our first chapter is best pairs. We already discussed it in the last video. If you don't watch that, I'll leave that link in cards. You can watch from there. So I don't want to explain it deeply. I just want to discuss the main points on this topic. As we discussed, we only trade in gold and GBP JPI. These two pairs we trade every day. Personally, I trade them from 2 years. Those are perfect to our strategy. And in these pairs, my 90% trades are in gold. We have to have full grip on the fundamentals and technicals of gold and GBP JPY. We will discuss these all topics in future. Why do we trade in these two pairs? Because these are low volatile and have high volume. Ultimately, they are very smooth and less risky. Moreover, with two pairs, you can easily analyze the movement of the pairs. So what am I saying is, trade only one or two pairs. Beyond that limit, you can't manage them. That's why in our strategy, we set a rule that stops you from overtrading, blowing accounts. So what am I telling is watch only two pairs, only two sessions and only two trades per day. Let's move to next topic. Perfect broker. In Forex market, so many brokers are there. In those, so many shit brokers also there. You may ask me, okay bro, tell me how to identify them. That's I am here. Let's take stock market as an example. For every big economies, they run stock market. Like India's stock market, USA stock market, Japan's stock market. So these all are not run by freely or autonomously. They regulated by strict organizations. For example, Indian stock market regulated by CB, USA stock market regulated by SE. Why should a market be regulated by strict organizations? Here is the logic. If they don't regulate it by then, there will be chances to happening scams. That's why markets must be regulated by some organization run by government. Like that Forex market also. But bro, Forex is trades by all over the world. How can a particular country regulate it? Yeah, that's why Forex brokers are not regulated by a single regulator. They are regulated by multiple regulators backed by different countries. By this, we can trust Forex brokers. These are the main parameters. The first one is order execution standards. The second one is competitive pricing. The third one is range of markets. The fourth one is diverse account type. The fifth one is trading platform and tools they providing. And the last one is supporting content. These are the main parameters that any professional trader can consider before he chooses any broker. Let's discuss each one. Order execution. Using a unique methodology to assess the risk of price manipulation, we verified whether brokers have a best execution policy and checked their average execution speeds. Competitive pricing. We checked the spreads, swaps, and commissions charged by a broker to determine the competitiveness of its fees. Generally, round turn commissions of $6 per traded lot and floating spreads from 1.0 pips are considered average for the industry. Range of markets. We estimated how many instruments and from which asset classes brokers offered, considering the flexibility afforded to its clients. Diverse account types. We assessed brokers' minimum deposit requirements, maximum leverage, and maximum traded volume per account type and chose those that offer the greatest variety of account features for the lowest possible cost. Trading platforms and tools. We selected brokers offering user-friendly platforms and feature-rich that can cater to both beginners and experienced traders. Supporting content. We preferred brokers with an extensive assortment of third-party and in-house research tools. We also assessed the scope and applicability of the available educational materials. In this way, a broker can determine as regulated. Apart from these, you can ask me like, okay bro, then how to identify that particular broker is good? Here the process. There are several things you can do to verify if a broker is regulated and by which regulatory body. When you open a broker's website, you can scroll down to the bottom of the page to see the entity's legal name. This is where it is stated who the regulator is. You need to look for a reference licensing number, which you can then use to verify the entity by going to the regulator's own website and checking its registry of authorized entities. You also need to assess a broker's transparency about order execution and whether it can be trusted not to manipulate price action. You need to check whether the broker has a best execution policy, publishes regular quality execution statements, and states its average execution speed. Here some regulators list based on protection level. The less the tier, the more they strong. Means if the broker has tier 1 regulator, means it is more safer than compared to other brokers regulated by tier 2 or tier 3 regulators. This was just a trailer part to selecting a broker. In future, I will make a full detailed video on how to select the best broker in Forex market. So let's move to next chapter, setting rules. If you watch this video up to this, I think you might like my videos. Please subscribe to this channel for more content like this. Share this video to your trading friends. Click on bell icon for faster notification when I uploaded videos in this channel. This was the most important thing in the Forex market. Why? Because without any particular rules-based strategy, you cannot see any profits. So rules must be set. Here the question is, how to set rules? That's why I am here. For any strategy, if it has less winning rate or high winning rate should know. Because according to that winning rate, we can set rules to give an edge to our strategy. Then what is the meaning of edge? Here I am to explain to you. The edge of strategy is nothing but the management of risk while the market against you. It's nothing but when you win the trade, you gain more. But when you lose the trade, you lose small. Let it make simple. For example, you took a buy trade. When price moved some pips, you have to close some partials. I think you know how to close partials. Let's look at other side. If you took the same buy trade, but this time the price moved against you. The price moved halfway towards your stop loss. You have to close 50%. Remaining will automatically closed if the price hit your stop loss. Or the price may move to your direction. That's why we leave the runners. Okay guys, what I said up to this in this chapter is the first rule. So the first rule is managing our trade after executing. Purtis said we will discuss it later. Next, second rule is trading in only high volume timings. So you may ask, bro, what are the high volume timings? I made a detailed video on high volume timings. I recommend you to watch the video. I leave that video link in cards. Now I discuss that topic up to a level. Here are the high volume timings as displayed on screen. Here high volume timings means when banks and big institutions are actively trade in Forex. So here point is when they trade. How we know the timings. All questions will be answered soon. If any banks and institutions of a country wants to trade in market, there must be their market open. When their markets open is the matter. If we know the particular country market open, then it is easy to know the bank's timings. We all know that. There are three major markets in Forex. The first one is Asian session. The second one is London session. And the final one is New York session. So what we know about these sessions is, look at this photo. Here we can see the openings and closings of different market openings. And also we can know the overlapping timings. These all are in IST. I think you understand the high volume timings. Third rule is, there must be a clean range. Clean range means, when you look at left side there must be no consolidation. Minimum 25 pips range needed to take a trade. And the fourth rule is, 2 trades a day. It is for stopping us from over trading. And the final one is, Don't trade while high impact news is there in 30 minutes. These are the rules of our strategy. Let's move to next chapter, journaling. Journaling is also most important. Through this, you can identify your minuses in you. Then you can eliminate them easily. For sample purpose, I am showing one of my journal. Look at this, how I journal my trades every day. In future, I will make a video on how journal like a professional. What is risk management? Firstly, why do we have to manage risk? Is it necessary to learn risk management? When should we manage risk? What if we don't know how to manage risk? These are the questions that arise in your mind while you first listen this word for the first time. The other who knows it before may think calculating lot size is risk management. But unfortunately, that was top of the glacier. It looks easy and simple, but we can't see the bottom of it. It's a lot and heavy subject. Newbies pay lots of money for the courses. I will tell you the whole theory behind the risk management in this video. For that, I want only one thing from your side. If you think this video helpful to you at any point, please subscribe to our channel for genuine and free content. Let's get into the video without wasting time. Our topic is risk management. For simplification, I am dividing it into 4 chapters. Let's discuss one by one. The first one is risk per trade. The second one is winning rate. The third one is observing trade in MTC. MTC means multi-time frame. And finally, we will end this video with few examples. These are the 4 chapters we're gonna discuss in this video. Before going to the first chapter, I recommend you to write down what I am telling in this video. It will helpful to you in future. And simultaneously take screenshots every drawing. It will help you as reference when you're reading your notes. So here I am, your Hope Tips. Learn with me. Grow with me. Pass accounts with me. Let's discuss the first chapter, risk per trade. What is risk per trade means? It means how much risk you want to take in a trade according to your account size. That means we calculate the risk according to your account size. You may ask me, Mr. Hope, give me formula for calculating my risk. Okay, I will discuss that later. Before that, we have to decide how much risk you want to take per trade. It will depend on individual. A professional trader takes 2 to 5% per trade, but it is not recommended to beginners. So how much risk is good for beginners? Average 0.5 to 2% risk per trade is good for beginners. I think you understand my point. 0.5% to 2% risk per trade for beginners is good. Above these levels, I'm recommending you. Please don't overgreed. You may blow your account. Moving to the first question, the formula. See, this is the formula for calculating your lot size according to your risk, but it is not applicable to all risk percentage. So what we can do? Firstly, we have to calculate the max lot size. For calculating this, we have to know how much leverage your broker gave you. For example purpose, we take 1:30. After that, add your account size, then calculate your max lot size. This is for only funded traders, because these companies reduce leverage for commodities like gold, silver, etc. So for us, we can take 0.5% risk per trade because of this rule. Personally, I don't use this old method to calculate my lot size. So what I am using? At beginning, I am using this AG risk calculator indicator in TradingView. I am giving this indicator link for free for all our members. This link available in our Telegram channel. Our Telegram is Hope Pips. I will give the links in comment section. From there, you will direct to our Telegram group. From there, you have to go to Tools section. All free tools links are available there. Use them. They all are free. But now I also not using this indicator. I am using Magic Key. This tool is epic. Very useful to quick calculating lot size according to your percentage of risk per trade and your stop loss. You can also manage the trade after execution. I don't know who developed this indicator, but they are awesome. Now I will show you how to use this. Hear this. I have virtual magic key. It's a port only in MTF and CTrader. I am using CTrader. So when you open your CTrader, you see this pop-up window. Just you have to input your risk per trade. Then click on this button for what you want to take, either sell or buy. Then adjust these lines. The red line indicates your stop loss and green line indicates your target. After setting them, click on this trade button. Trade automatically executed. Now actual plan starts from now. You can close your trade where you want to, and also you can close partials at where you want. This is how I am using this epic indicator. If you want detailed video on this indicator for how to install and use this indicator, ask in comment section. According to that, I will decide. So this is how we calculate lot size. Okay, let's move to next chapter. Winning rate. Knowing your winning rate is very important. If you don't know it, it's okay. It's very simple to calculate your winning rate. Look at this formula. You may think, is that mandatory to remember these formulas for Forex traders? My answer is absolutely not necessary. These days, so many websites and apps make it simple. We just have to enter our every trade details in those websites. They automatically calculate our winning rate. They tell your average net gain. They tell your average net loss, your maximum drawdown, average pips you gain, and so on. But I don't use them now. I created my own journal sheet in Excel because I don't want to give my valuable content to untrusted parties. There were no other reasons. So look at this. This is my journal page. In this, I enter all details of the trades I take every day. It will give you everything. Means your winning rate, your maximum drawdown, your average profit, your maximum profit like others. But in addition to, it also gives you the percentage of trades you take in every setup and percentage of trades you took in different timings. So you may ask, what can we do with them? Okay, it's confusing to you, but if you know the timings at which our setups work well, or our skills beat your emotions, all these are parameters that decide your discipline. If you want a detailed video on my Excel sheet, let me know in the comment section. I will read all the comments. According to I will make a video on how to use advanced journaling sheets. I think you understand how to calculate your winning rate and smart ways to calculate it. But the main thing is why we have to know that. Because according to your winning rate, you can adjust your risk reward ratio. Here another question came. What is the risk reward ratio? It's nothing but what you risk for a reward. Suppose you want to set your stop loss at 10 pips and your target is at 10 pips. In this case, you are risking 10 pips for 10 pips. That means it is 1:1, or your stop loss at 10 pips, but this time your target at 20 pips. In this case, your risk reward ratio is 1:2. Look at this picture. How risk reward versus winning rate decides your strategy edge. You know that every strategy have average winning rate. According to my backtesting results, our strategy has nearly 75% winning rate. And we mostly aim for 1:1 risk reward ratio. That means what it shows for winning rate 75% versus 1:1 risk reward ratio is. See, it shows green box. That means we are in profits. In this way, we can anticipate. So for more details, in 1:1 risk-reward ratio, at least greater than 50% winning rate is enough to gain profit with our strategy. Even below 50%, what bro? How can you in profits below 50%? In the chart it shows we are in loss. But you said we can make profit. Are you mad? Oh, oh, wait buddy. Here our risk management play a major role. As I said, when we lose a trade, we only lose only 70% in actual loss. That is the trick in our strategy. So according to our strategy, if you're in the profit zone, even your winning rate is 45%. Is it not awesome? Let's see how other winning rate works. If you aim for 1:2 risk reward ratio, you just have to maintain minimum 40% winning rate with your strategy. Otherwise, if your winning rate below 40% means you are in loss. Next, if you aim for 1:3 risk reward ratio, you just have to maintain only minimum 30% winning rate. But here taking 1:3 risk reward ratio trades is very tough job. You to be more patient in this world. So like this our winning strategy. Here is why I am telling. So grabbing 1:3 risk reward ratio trades very rare. Tell me how many trades you took in this year 2024. Literally very few trades. If you ask me the same question, my answer is I only took 3 trades in this year. Those trades gave me into 4 reward. Like this. Just aim for 1:1 risk reward ratio. Stress free trading. No emotions carried trades. Then ultimately you will see the profits. So this is the magic of the winning rate. I hope you understand this. How to know winning rate. If you have any other doubts, ask in comment section. I will answer all questions. Let's move to the next chapter. Observing in MTF. If you watch this video up to this, I think you might like my videos. Please subscribe to this channel for more content like this. Share this video to your trading friends. Click on bell icon for faster notification when I uploaded videos in this channel. What means MTF? It's nothing but multi-time frame. So observing in multi-time frame is very important because in higher time frame candle may have structure in lower time frame. You may miss the logic behind price movement. For example, see this photo. What you observe, price in uptrend. So higher chances for the next candle also move bullish. But what happened? Price moved downwards. Can we tell the reason why this candle moved downwards by looking at this time frame? Absolutely not. So what we have to do? Just observe in lower time frame. There may be a structure break happen. So let's move to lower time frame. See this the 30 minutes time frame bullish candle by combining these two 15-minute candles. What happened next? A small bearish 15-minute candle formed. What is the probability that the next candle move bearish? Low, right. But look at this. This candle breaks the previous candle low. What that means? Up to this candle price action makes higher highs and lower lows. But this 15-minute candle broke the trend by forming a lower low. So what can we expect next candle? Bearish, right? As we anticipate the next candle moves bearish. So this is the reason why this candle moved bearish in 30 minutes time frame. Any know about this setup? If anyone, then write in comment section. So like this smaller time frame helps us to read charts efficiently. Practice more. Okay, let's move to next chapter. Examples. In this chapter, we're gonna discuss 3 examples. With these examples, I will show you how to manage a trade. Let's see the first example. This is chart of gold. Firstly, what we do when see a chart, drawing support and resistance. So let me draw support and resistance here. Here, this is the support area. Then draw a support line. And this is the resistance area. Then draw a resistance. And see left side clean range. So draw a line here for understandable. If this candle breaks previous candle low, I will take sell entry because as per impulse entry rule, it satisfies all rules. See candle breaks previous candle low, so I take sell entry and my stop loss at previous candle high. As per candle rule, high probability of next candle moving bearish. Right. So let's see what will happen as we expect candle move bearish. Oh, wow. This candle moving against us. We don't see any indication for upward. Then why this candle breaks previous candle high? To that, we have to go to lower time frame. This is 15 minutes time frame. See this candle breaks the previous candle high. So I want to close 50% at this movement. See again price move upwards. I close total position after this candle breaks previous candle low. Why I do this? Because when in lower time frame structure breaks, then in higher time frame price will move opposite direction. Look at this trade, I lose only $10 instead of $20. This is called risk management. Let's move to the next example. This is again 30 minutes chart of gold. Here is the support zone. Let's draw support here and draw a resistance here. If next candle breaks previous candle low, I will take impulse entry. Let's form top wick first. See candle closing time. So wait for close. Yes, I closed. If next candle breaks this candle low, I will take breakout entry. Here I entered after this candle breaks previous candle low with stop loss at previous candle high. Let's move to lower time frame. Lower time frame also in downtrend. Look at this. This candle breaks previous candle high. So in lower time frame downtrend breaks. So I am closing 50% of my position. Let runners run. Wow, look at the our runners done a good job. So I will close 50% in remaining. So here I close all my position. Let's see the results. See, finally we got $21 profit. So let's move to next example. This is our support zone. Let's draw support. And this is our resistance zone. If this candle breaks this support, I will take sell. Or it breaks this resistance, I will take buy. Let's see what will happen. See, it breaks support. As per our plan, I take sell entry here. Then let's move to lower time frame. I am closing here 50% of my position because price moved halfway towards our stop loss. See here a dozy candle formed. If this candle breaks previous candle high, I will close another 50%. So it breaks. So I am closing another 50%. See price moving in our detection. My target is here. I will close total position at here. Look, price reached our target area. So I am closing total position here. Let's see results. Look, I lose only $13 and our runners gave $23. Finally, we are in profits. Like this, I manage my trades every day. Like this, I cut my losses small. And ultimately, at the end of the week, I remain profit. So I think you understand how risk management works, how it protects your capital, and give a push to build $1 million account. Thank you. This is the end of the video.